Okay, well, I'll get started. I'm just going to, it is recording, and I'll just keep questions to the end so we can streamline this. The whole idea about today is I want to share how you can build intellectual property value using risk management. So in the past, we've looked at this and said, we take a guess, I like this, therefore other people will like it, so let's spend money on patenting and design, development, commercialization, and then finally you find out the public like it, but they don't want to spend the money on it. What we want to do is make sure that we de-risk the entire project before you get started. So might sound like a technical subject, but actually this is the most practical commercial question an inventor can ask yourself. And you need to do this on every project. And most IP projects don't fail because the idea was worthless. In most cases, too many commercial questions get left unanswered and for way too long. And by the time you get to answer them, the answers are negative. So we want to make sure we can keep that as positive as possible. Generally what happens is ultimately the market isn't clear, the buyer profile isn't clear, path to revenue doesn't seem too clear to you. The ownership and how you defend it is going to be not so clear, unless of course you've bought patent attorneys in early. Costs aren't clear for you to get this started, and also marginal cost as you get going. Partner pathway is not clear, and partnership is a very important part of any IP commercialization, and we'll show you why that is. Now, every one of these is risk. Every risk unresolved reduces the chance of getting funded, licensed, distributed, or getting this entire thing sold if it doesn't fit your portfolio anymore and you want to find a buyer for it. So today, I want to give you some practical ways to assess an IP opportunity before you spend too much money, before you pitch it, before you discover these commercial weaknesses that could make it fail if you're not careful. So today's webinar is about a different way of looking at risk. Most people think of risk management as something defensive. Sounds like compliance, insurance, legal protection, or caution, but in IP commercialization, risk management is one of the most important ways to build value for you. When an invention or an R&D opportunity is early, it's usually full of unknowns. The market may not be proven, the customers may not be clearly defined, the commercial model may be incomplete, and that commercial model is critical. The cost may be uncertain, the IP ownership may not be properly documented, the route to market may depend on partners who have not yet been identified, and that's critical as well. These unknowns are not just gaps in information, they represent your commercial risk, and that's something that nobody wants to buy into if they want to partner up with you. The more risk the project carries, the harder it is to attract funding, licensing, distribution, or acquisition interest. And that's what we want to do. We want to get your first significant cash generating transaction as quickly as possible. We generally do it in a 100-day sprint. Now, I want to just go through why good IP fails commercially. The problem is generally when the problem's unclear, what the prospective buyer can't see how this will help them. Is it the same for partners? So this sort of thing always happens. The buyer's unclear. Are there enough people with the problem who have to buy a solution at that price? The commercial model is weak. So if you have a proof of concept, market validation, pricing, costing, sourcing, layers and players are all mapped out, they're the channels that you're going to be using to get this product to market. If the risks associated with any of those is unresolved, if you solve these, you're just pushing them. If you don't resolve these, they're pushing out to other parties, and that means the risk is still there. It's just not, you're trying to push it to other people and they're not going to buy it, because generally, if you right partner, they'll be from your industry or your market. And as a result of that, they will understand the risks better than you do because they're already in the industry. So the pathway that we're trying to get you is to first revenue. And if that's missing, what would be your first significant cash generating transaction that you're going to aim for? You need to know what that's going to be. Okay, so if we just step forward, how certainty prevents failure. So if we go through that quickly, without assessment, money is spent before the commercial pathway is clear. Patents and prototypes are funded too early. Investors and partners see unresolved risk. Team pursue projects that may never generate revenue. That happens quite a bit. Years could be lost on projects that could have been redirected if you did assess this early and didn't hesitate. Now, with a structured IP information or an IP opportunity audit that's looking at the opportunity before it comes a product, then you've got other areas where you can start to push this. For instance, a clear pathway to first revenue. It becomes far better for you. There's risks are identified before major spending occurs. The right partners and channels become visible. The commercial viability can be discussed with evidence, and that's important because if you can prove what you're claiming, those people will support you, and that's how you gather partnerships rather than investors. Investors don't come into projects that don't have cash flow. So that's why 96 or 97% of projects never get funding. It's because they go after people for investment, and we don't. We go after people for partnership, because those are the people who understand the risks. And finally, teams gain confidence to commit resources with discipline. If you have that discipline and structure in there, they're going to help you. So those investors, those partners are starting to relax about where the risks are. They understand that you've mitigated them or at least addressed them. And your objective is not to remove all the risk. It's really just to contain it and declare it. And that's what we do. So the premise of IP assessments is pretty easy. Clarity. Clarity is to know that enough of these will sell with enough margins for all levels. That's all levels of the distribution or licensing hierarchy. For instance, you've got a big box retailer that might take your hardware product, but you also have to have a distributor. You also have to have the OEMs buy into that at another level. And I'm going to give you an example. We'll work a case study today with a small hardware product that we did at 3 levels: distribution, OEM, and also retail. And we'll show you how that all worked out, and how it was the inventor was so confident in his first 100 days that he actually expanded from one country to global, and just let's push the button and go. And we're already into now 2 countries. So unknowns can kill a project, as you know, but they can also eat your cash flow. So what we need to have certainty, and we need to know what certainty we need. Now, the resources you need are not infinite. Your time and your capital can start to hurt your current financial circumstances if you're not careful. Finally, you have to ask yourself, do you have the right data to make an informed decision that you can prove to other parties? That those other parties might be partners, they might be bosses, they might be friends and family who are going to kick in early. All of that needs to be known. So we want to de-risk that by showing you what that information is and documenting it with you. Now, in this session, I want to take you through the pre-commercialization assessment approach. This is not about writing a long business plan before anything can happen. It's about knowing what needs to be known before serious commercial decisions are made. We'll look at how to identify the unknowns, how to understand value from the prospectable parties or perspective, and how to reach a disciplined go, no-go decision point. That's critical in these. The decision point matters. Not every idea should be commercialized. Some should be shelved, some should be abandoned, some should be suitable for sale or reassignment to another party. It really depends on making sure it fits your current portfolio as well. Others may deserve serious investment and commercial development, and they're the ones you need to latch onto. We'll also look at the use of checklists and how almost all of these topics have in blocks of 4. So everything I'm going to show you from here on in is in blocks of 4 for some reason. That's the way it works. It could be just the way my mind works, but still. So all of this will give you the practical steps by which an idea can be moved from uncertainty towards commercial readiness, which is everything you need to know. So what you need to decide is pretty easy. This is one of the most important slides for this webinar today. Many inventors and organisations assume that once an idea exists, the next step is automatically to commercialise it. That's not always true. A disciplined commercialization process should help you decide whether to commercialize, to shelve it, to abandon it, or to sell off the project. They're the 4 decisions you have to make. It may sound harsh, it's actually protective. The worst outcome is not always failure. Sometimes the worst outcome is spending years and large amounts of money on a project that should have you been stopped very early. It should maybe have been paused or redirected or sold much earlier to someone else who could do a better job of it. A good opportunity assessment does not simply encourage enthusiasm, it brings discipline to the decision. If the opportunity is strong, it deserves support. And if it's not ready, it may need more work. If it's weak, it should not keep consuming your resources. And if it has some value but doesn't fit your organisation or your personal capacity or capabilities, then selling it off might be the best commercial decision, and you at least get something back for what you've done. So to assess the opportunity properly, I like to begin with 4 practical scoring areas: utility, value, market, and industry. They're the real key to this. So we're looking at this as it's not quite a map, but you can see that the higher the scores on these, the more likely you are to be able to control or contain any of the risk. Utility asks whether the idea genuinely solves a problem and can make money or save money for people who are with the problem. Value asks whether the solution can produce a commercial return for you if you're able to produce it and then deliver it to the people who need it. Market asks who might be the people who buy it, who use it, who fund it, who distribute it, or who benefit from it when it's in the field. Industry asks who already has the capacity, channels, infrastructure, and commercial reason to support it for you. There's no point in you building an entire sales channel if one exists out there. You simply partner with that person or that entity and push your product into there. That's going to be a lot cheaper. And of course, that means you can offset the cost of building that channel with equity for that party. Now, that's important because many inventors assess their opportunities only from the product perspective. They ask themselves, is this a good idea or is this patentable? Those questions aren't enough. The best question is, can this become a commercially attractive opportunity for all the parties needed to bring it into market? That's the answer you really need. So if I just go through those 4, utility is the first test, of course. Before we talk about patents, funding, pitch decks, or valuation, we need to ask a simple question. What problem does this solve? When we need to ask this and who it solves the problem, who has the problem and who does it solve it for? This is where many projects start to weaken. The inventors may be clear about the product, but less clear about the customer or the user or the buyer or the organization that will benefit. Once we've done that, we ask how the problem is being solved right now. That matters because people rarely move from nothing to something. They usually move from an existing behavior or product workaround, supplier or process or compromise. Finally, we're asking whether they would change. If they're quite happy with what they've got, and I've had really good projects that definitely deliver value and people have just said, no, we're not going to change because what we've got isn't broken, we're not going to fix it. So that's a powerful question. A project's much more stronger when the reason to change is obvious, urgent, and it's measurable and it's commercially meaningful. Not every project is. So you need to be able to articulate that before you start. Now, utility is not quite enough though. Sometimes it can be useful without being valuable enough to commercialize. So the next question is always value. What could it generate in revenue? What might it be worth? How would it be owned and protected? And when can it generate early cash for you? The last question is critical because it takes away your risk. In early stage commercialization, I've often encouraged people to think in terms of first revenue, not eventual scale. A project doesn't need to become a global company before it can become valuable. It may first need to secure a license or a distribution agreement, a funding partner, a pilot order, a strategic collaboration, or a trade sale conversation, but not necessarily the entire thing, just one. Because you can use the cash flow from the first to generate the second and then continue before you then have a sequence That sequence gives you momentum, and that's where investors, the true investors, come in, because now you've got cash flow. So early cash changes the project completely. It creates evidence, it creates momentum, and it shows that someone else sees the value. It can also reduce dependence on speculative capital raising. So it takes away those people who are just in to get out. We want people who want to be part of what you're doing or building. Now, when people describe the market for an invention, they often jump too quickly to the global market. We always hear about total available or total accessible markets, TAM as they call it. And it's crazy because as I had an argument with somebody who developed something for tyres, and he said the total available market, I think, was 32 billion or something per year. And I said, yes, but every tyre manufacturer and every tyre retailer advertises in their particular jurisdiction for business. Are you going to match their advertising to get your share of that? It's never going to happen. So the 30, 60 billion or whatever it's going to be for revenue or total available market, or your share of that total available market is only yours if you can match the advertising, and you can't. So when people describe the market for invention, they often jump into that global market and they say, everyone can use this. This is a global opportunity. Well, no, not necessarily, because you can't access that market. That might eventually be true, but it's not where good commercialization usually starts. We need to understand that the market is in layers. First, you own your own use. How have you made money from this? Has the solution solved a problem for you or your organization? Then we look at local users. Can the problem and solution be validated nearby? And do they have the same problem? And will they look at solving the same problem the same way you did? Then we look at national. Is there a broader pattern of demand for that? In which case, can we advertise to them? Can we access them? Will they then make a decision to buy? Once we've done that, then we can generally make an articulation or an assessment on global users. Are there markets with similar pain, similar buying behaviour, and similar commercial pathways? That stage thinking matters because market risk is reduced through evidence. You don't need to prove everything at once, but you do need to show where the first credible market evidence can come from, and then you can then extrapolate from there if you can prove it first with yours and then locals. Okay, the market tells us who we may need or want in the solution. The industry tells us who we can help bring to the market, and they might have the channel already. This distinction is important. An inventor may focus only on the end user, but commercialization often depends on the industry player. These may include manufacturers, distributors, wholesalers, installers, OEMs, which are original equipment manufacturers, the prime manufacturers in that industry. Could be consultants, regulators, trade bodies, certification groups, large customers, and potential acquirers. I've used all of these to get partners to leverage into an industry. We also need to understand the layers in the industry. Who influences the purchases? Who controls supply? Who owns the channel, the sales channel? Who already has the relationships with the target buyers? When we look at geographic reach and demographic scope, that also adds another layer of complexity to this. The commercial model may not be, it doesn't need to be global from day one. It may be possible to license by geography, by application, by sector, or by demographic market. So geographic, demographic, or geographic on demographics. So you might have, I'll only do it for automobiles for North America, and I'll do buses and trains separately for my particular product, or I can do the same thing for Europe. So you can break it down and layer. This is a way of cutting the cake so you get more slices. And each one is just as valuable. Now, this slide is fairly central to today's talk. So when I work with inventors and R&D teams, I often focus on first revenue objectives rather than distant scale. There are 4 practical early commercialization pathways: funding, distribution, licensing, and trade sale. They're the significant cash generating transactions that we aim for. And we generally say, pick one product, pick one of those 4 to go for, and then we do that in 100 days. If we can do that, the funding then, or whatever the money you've got in the bank from as a result of these, can be used to generate your second and then consecutive, and pretty soon you've got momentum and people will invest in you when you've got sales and you've got revenues. Now, funding might come from an investor, a strategic partner, or commercial collaborator. We prefer the other two, not the investor. Investors are way too hard until after you've got cash flow. Distribution allows someone with an existing channel to sell or place your product. Licensing allows another party to use the intellectual property, manufacturing rights, know-how, brand, process, or technology in exchange for commercial returns. A trade sale may involve selling the product or the project, or the intellectual property for that matter, or the commercial opportunity to a party better positioned to take it forward. It might be that you've decided this doesn't fit what I've got, but it does have value. Let's go find a buyer for it. The important point is that commercialization doesn't have to mean building everything yourself. In many cases, the best early deal is the one that gets the project into the hands of a partner who already has the assets, the channel, the credibility, and the urgency to act. You solve their problem as well as their customers' problems, they're going to start distributing it. Imagine how cheap it is for somebody to get on board if all they have to do is blast out an email to 1,000 of their past clients in the last 3 months or 12 months to say, you bought A from us, we've now got X, would you like to buy X alongside A? It works in comparison to it, or it's a complement to it. And at the same time, we'll give you a 30-day trial. At the end of 30 days, you don't like it, send it back. Otherwise, we'll bill you for it. That means their marketing costs have pretty much been about 10 cents. And they've got it out to 1,000 potential or prospective customers. That's how easy it can be if you pick the right partner. Collaborators are everything, and this is the partnership, the collaboration. Once we know first revenue objectives, we can start thinking about who the collaborators should be. The question is not simply who might buy this, it's also who in the industry could benefit from helping us, and where would those buyers look for this? Now, who already has the market access? Who has the production capability? Who has the technical expertise? Who has the customer relations? Who has the credibility? Who has the incentives for it? All of these questions need to be answered. The best collaborators for you are often not outsiders to the industry. They're already people operating or entities operating inside or near the target market. Now, they may also be able to supplement their participation with grants and tax incentives, infrastructure, staff, plant, equipment, or regulatory capability. They might have connections that will help you and speed up everything you want. This is why collaboration is such an important risk management tool. It can reduce the amount of cash required, increase the project's credibility very quickly. And of course, all of that can be traded off. So collaborators can provide much more than money. In fact, money may not be their most valuable contribution. They can provide pre-sales and sales channels. They can be more valuable than capital because it gives you the project access to customers, and it also gives you a quick track record. They can provide facilities and infrastructure. They may reduce the need for new capital expenditure. They can provide expertise. They may reduce the technical and operational risk. They can provide production capacity that might allow the project to avoid building its own manufacturing base. You don't have to if they've already got it, and you rent something from within their operations sphere. This is the leverage principle. If a partner already has what the project needs, the project may not be able to move forward faster, cheaper, with less risk, but it can if you are able to leverage off that. So instead of raising I had a project where we needed to raise $500,000 for all the plant equipment and infrastructure that we needed and the facilities we needed to rent. But instead, we partnered up with somebody who had all of that. They rented a corner of their factory for the operation. They gave us access to laser cutters, CNC press, gantry cranes, forklifts, racking, everything we needed, steel and expertise, welders, inline welders, everything. And we were able to, when we narrowed it down, the $500,000 became $88,000 in cash. That's it. And then we offset their risk with another leverage, which was we went out, this product allowed them to sell their product with no installation fee. So it saved the customer 30% straight off the top of the overall price. So we said, go out and talk to the people who didn't buy from you when you quoted them and ask, would they buy if it was 30% cheaper? And that pretty much covered their 88,000. In fact, it was, I think, 2.6 million in the last 6 months of orders. So they knew they had a winner and there was no risk. So we de-risked their entire project simply by using a collaborator from the industry or the market, and it immediately took off. So now we can reduce the cash requirement if we're careful. This is one of the most important questions in early stage commercialization. Can we reduce that capital requirement? Many projects fail because they assume that everything must be funded in cash. Cash for development, cash for plant, cash for marketing, cash for distribution, cash for staff, cash for compliance. But a good commercial model looks at ways to reduce or offset those needs. You still need it, but you don't have to pay cash for it if you partner up with the right people. Pre-sales may fund early production, for instance. A collaborator may provide facilities or plant, tax benefits or grants may be support the development that you're going to do, but you don't have a benefit in terms of getting cash offsets or tax offsets because you don't have any tax obligations yet. But they do. So that if they came in as a collaborative research partner, they can actually claim those. A partner may provide skills, expertise, local presence. There's a lot that they can do. This doesn't mean that the project becomes free. It means the funding requirement becomes more intelligent. And when you reduce the cash burden, you reduce the risk for them and for you. And when you reduce risk, you improve the chances of getting a deal. Everybody wants to do a deal with you. If suddenly 500,000 becomes 88,000 and you can immediately show them $2.6 million in sales, boom, that deal happens immediately. In fact, that guy, when we presented that product to the first one, they said yes. We presented it to a second and they also said yes. And then one of the people within that second group talked to someone else who then drove about, or when he flew to the new city closest to this prospect, the inventor, he then drove up to him, which is about 250 kilometers, 150 miles, to visit him on his farm and said, I want to invest in this. So they had 3 from 2 presentations. That gives you an idea how capable that can be if you do it right. Now, the commercial model, as I mentioned, is where the value is. It's not in your widget or your idea or your concept. It's all about the commercial model you wrap around that to give you the money that this project can generate. It becomes where the opportunity becomes real. This is where demand, pricing, costing, sourcing, fit, and the project risk all come together for you. Demand tells us whether the market wants the solution, and pricing tells us whether people will pay enough. Costing tells us whether there's sufficient margin for you, and sourcing tells us whether or not the product or service can be delivered reliably. And so you can always get access to the components or the recipe or whatever it is. Fit tells us whether or not the opportunity belongs with us or with a partner, with a licensee, with a distributor or with an acquirer. So if it's nothing to do with you, but it's a great idea, find somebody to buy it from you. Project risk tells us it could still prevent the opportunity from moving forward. This is why I often say that the commercial model is more important than the invention itself. The idea might create interest, but the commercial model creates action, and that's most important for you. Okay, so the research is how we convert assumptions into evidence. At the early stage, we don't need perfect information, but we do need enough evidence to make better decisions. Now, secondary industry reports can help us understand market size, trends, players, pricing and growth. I like to get reports like ibisworld.com, ibisworld.com. Great way to look at an industry. I did one recently for the concreting industry where we had an innovation for concreting, and it gave us all the trends, all the growth, all the areas where they're sticky, and we knew from that also the major players and their growth and who was going places. So we could pick our number 2 and approach them and say, would you like to be number 1? We've got a product that will allow you to get there. So those secondary industry reports can help you understand the market size, trends, players, pricing, growth, all of that. Testing the problem and the solution helps us determine whether or not the market recognises the issues and values the proposed, gives you the value of the proposed, all those answers that people give you. Testing the prototype on prospective buyers gives us feedback from the people who may eventually influence the adoption of it. And that's important because you want to make sure you understand what their problems are and that they understand what your solution is. Now, building the numbers to support the project helps us to avoid vague claims. This is where many projects improve dramatically. Once the assumptions are tested, the opportunity becomes clearer. Sometimes the project becomes stronger. Sometimes the research shows us that the project needs to be changed, and that's an important aspect of it as well. Sometimes it shows that the project should not proceed. All of these outcomes are valuable to you because you still haven't spent money on patents or design, prototyping, whatever. By this time, you've done the assessment before you've started. Now, the IP Opportunity Audit, which is the tool we use to do this, the purpose of the audit is not to produce a thick report that nobody uses or a business plan or something like that. It's to qualify the ideas quickly and create decision clarity. The audit helps assess whether or not an opportunity has enough utility, value, market interest, industry support, commercial logic to justify further work from you. It helps identify the cost and revenue models. It helps uncover the risks attached to each of these opportunities and helps support one of 4 decisions. Do you commercialize it? Do you shelve it? Do you abandon it? Or do you sell it off? But that decision discipline is important for inventors and organisations alike. For inventors, it can prevent years of misdirected effort if you're not careful. And also, it'll take all your time, all your spare time away from your family, etc. And it can also take all your savings if you're not careful. So you need to have the answers before you start. And for organisations, it can prevent valuable intellectual property from being ignored, wasted, leaked, or developed without any sort of commercial pathway or thought to that commercial pathway if you're not careful. So it's most important to do the IP Opportunity Audit early before you start down that road. Now, there's lots of ways to do this. The best way to begin, the first is the commercial readiness test. This is a simple way to get an initial view of where your project stands, and it's free. The second is we have a macro opportunity audit. This is suitable for organisations that might have multiple ideas. So if you've never done this before, getting into one department or one site of your company, you might have multiple ideas, internal projects, process improvements, technical solutions, hidden IP opportunities across one site or across a department or across a team. And we sit down with all of them. We can do that live with them or online via Zoom. Now, the third is the micro opportunity audit. This is where you might have one particular project and you say, is this viable? Should I go ahead with this or not? Can I pick one of those 4? In which case, we need to know the answer. And what we do is, whether it's one specific invention or product or project or process or technology that needs a focused assessment. And finally, there's also commercial modelling where the project is taken deeper into demand, pricing, costing, sourcing, partner fit, and first revenue strategy. The key point in that, there is a structured pathway. You don't need to guess the next step. You can assess, prioritise, and then take action if you want. And it's all at your call. So you're not investing in prototyping or patenting before you know whether the project can return you an investment. So the macro audit, if I just dive into all of these, the macro audit is designed for organisations. A lot of organisations have more IP value than they realise, and it might sit inside departments, technical teams, process improvements, product applications, internal software, customer solutions, staff know-how, unfinished R&D projects. There's a lot there. The problem is these opportunities are often not captured or assessed. And the worst part about it with a macro, with where a macro audit can pick it up, is that the best people have these ideas, and if they're not championed, those people will leave and take the idea with them. So you've lost a person, the best person, and also the idea. And then you've got another competitor because they now are against you with a better product. So we conduct these macro audits site-wide or department-wide. We can do it by Zoom or in person, as I mentioned. And the aim is to gather ideas that teams believe may have commercial potential, and we conduct a rapid desktop assessment, and then we prioritise. So we give you a report within a week, or within 2 weeks, sorry. Now, that's especially useful for organisations that want to turn innovation into a profit centre rather than just letting it slide, rather than sometimes also can be a cost centre. It also helps management make better decisions about which opportunities deserve resources and which should be paused or maybe even discarded altogether. It's that shelving or trade sale that's important. But you get the information to do that. Now, the micro audit is for that one idea. It can also be for a company, but in a lot of cases, it's for individual inventors or small R&D teams. This is suitable where the inventor, founder, R&D team or business unit wants a focused review of a specific opportunity. The audit looks at the market and the industry context. It considers the risks and potential revenues. It examines whether the opportunity is commercially ready enough to move forward. The result is a go, no-go decision point for you. That doesn't always mean a final yes or no. Sometimes the answer is yes, but only after these risks are reduced. Sometimes it's not yet. Sometimes this should be sold or licensed rather than built internally. The value of the micro audit is that it can bring structure to what is otherwise or often an emotional or uncertain decision. We put it clear, black and white, independent, there it is, and it's very, very quick for you. I want to give you a case study here. This particular client wanted an OEM partner and a distributor for each territory. They have a very clever little product. I'm just going to describe it very quickly for you. It's called a wedge. These are used in door frames or jambs. And the whole idea is when you hang a door, you have to actually align it very carefully with the posts either side and lock it in. And that jamb or frame of the door needs to be rigid and it needs to be absolutely perfectly vertical. And that means that putting 6 of these, 3 down each side, and then adjusting them with Allen keys through the door jamb means you can absolutely level it very quickly. It means that these guys can hang, an amateur can hang doors in 3 minutes rather than having to have a really skilled carpenter or cabinet maker do the doors in any house build and take 45 minutes per door. So it can be a real big game changer for everybody. And these are little plastic shims that just drop in there, drill in, boom, all fit. And we knew that if we got the OEMs to take this on, they could actually pre-drill all the holes where they needed to be, and those holes get covered up by the doorstop when you lock the doorstop on. So we knew the industry. If I also show you that when you line it up, it's pretty easy. Once it's all locked in, you just usually lock it all on. You put the shims in, drill those. They're already key using tech screws from straight in, and then once that's all done, you're adjusting it. Again, it's a 3-minute job. Now, we knew when we examined the industry using an IP Opportunity Audit, we knew that there were 2 majors, and we looked at the Australian market. This product is actually from New Zealand, but it's Australian and New Zealand market. It's a common market. It's just like US and Canada. So we knew there were 2 majors, and we knew they did between 2.5 and 3.5 million doors a year each. And we knew what it would cost for those original equipment manufacturers to change their production process. We calculated how much of a pilot would cost each of them, and we wanted their 3+ million doors if they got on board with us. And we knew we'd probably only get one, so we were able to offer a limited exclusivity for a 12-month period. We got both of them to a trial, a pilot program. Their costs weren't cashed. We just gave them some product. They started producing them and then taking them out and marketing them to builders. They did some labour to offset against their R&D, and they were able to claim that as R&D, and their market testing was also R&D. So they did all of that. Eventually, we select one, which we haven't done yet, and we want to resell it to supply them. We went, at the same time we went to these guys, we also went to fastener suppliers, people who supplied them, people who supplied the big box retailers, and there's 2 major chains in Australia, including Mitre 10, which is in other places around the world. But there's one here called Bunnings, which is quite big. It's an equivalent of Lowe's. And they decided you needed to have a supplier, and we went back and they recommended the supplier. We did that, and once we've got that started and we're now in the trial period, the inventor had such confidence in this in the first week that he said, let's push the button and go to the US and do it there. So we're able to then immediately de-risk the project, proved it within a week, got the process going. We presented to all parties within a week. And then, because this guy flew to Sydney from Auckland and I met him in Sydney, we walked through, we did a trade fair, and afterwards we just dropped into 2 or 3 different places to sellers who weren't at the trade fair. We got them, we got the pilot programs going, we got the fastener companies interested in supply. We knew we had the margins to do it. We knew that everyone within that, we knew we could supply these to both builders who wanted it to save time, but also for amateurs, or let's call them handymen, who really had problems hanging doors. The biggest thing about door hanging was once you've finished it, then you have to call in a carpenter to fix it. And this way you could do it yourself and it'd be easy. So once we assessed all their risks in all of the different layers and players, we knew the opportunity and a net positive, particularly with pricing, and the owner, the principal, the inventor, was able to greenlight the project because of known margins and no known market. So now we're talking to people with who are doing 14 and 15 million doors a year. So you can imagine the opportunity as that goes up. They're sold in packets of 6, or they're sold by the thousands to the OEMs, of course. So how can this help? What's the end result that can de-risk it for you? It's pretty easy, really. If I talked about modern wedge, what we did was we clarified the commercial model. That included the original equipment manufacturers, the 2 major door makers, and we looked at their economics and we worked backwards from what it costs and what it would deliver for their customers, the builders. We looked at the pilot costs, how much it would cost them to test this. They agreed with our pricing. They also understood what the commitment was, and they also understood what the rewards were. We had modelled it for them using our commercial model. We worked out what retail pricing was and the distribution structure that would supply packets of these into retail outlets. And once we'd done that, we were able to then say, okay, major OEMs would agree to it. Well, we've got 2 doing the trials. There's only really 2 majors. And we started the distribution discussions, and we're working on that now. And we're also able to accelerate heading into the US. Now, I've got another project. I mentioned before, we had 2 projects that invested across in our groups. This is another project that invested across in our cohorts. One cleans out PFAS from flowing water. They're able to pump water up from groundwater or wherever and process it at 1,200 gallons an hour and remove all PFAS and then pump it back in pure water. And the other project does sanitation for agriculture and the likes. They're able to kill all pathogens using misting or fogging, and that was quite a big thing for cold chain storage. But across agriculture, these products were the same. So what these guys did was a joint venture. They focused to just 2 market subsets: cold chain logistics and agricultural pathways, and the joint venture was agriculture. So they focused limited resources with clearer markets, and they did pilot programs for deployment. And that meant that they didn't have to spend millions of dollars with 15 or 20 different pilot programs. They really only focused on 1 and then a second. And that meant they could focus their resources to a single cash event, and then from there afford to then reinvest in themselves to grow their projects until they had good cash flow. This is a very quick and handy one where we assessed the product and said this particular inventor had no way of producing the product, but he knew exactly what he wanted to do. So what we did is we did go ahead with a patent and then a design, and he built, if I explain the product very quickly, it's a way of adjusting air conditioners on vehicles. So what he did is he invented something which used Bluetooth and an app on a smartphone, and you could put these two manifolds in the input and output on an air conditioning compressor inside under the hood of a car, and then you can sit in the cabin and use the app to adjust everything and see what happens, watch what happens in real time. And at the end of it, you hit the button, it's all done. It sends a report to the owner of the vehicle, or fleet, his boss, and also to the operator. So it was very quick, very effective. And what he decided to do was, instead of just doing a license agreement, we built this software down to an EEPROM. We put it on a Raspberry Pi chip, and we manufactured the printed circuit board, and we're selling the printed circuit board completely licensed to somebody who wants to build the manifolds and do the rest. And so we've given them the designs for manifolds, we've given them everything and said, go ahead and do this. Here it is. Instead of just a $5 license fee, he's paying $27 for a printed circuit board, and he's selling that for $60, and they're getting $1,500 to build the whole unit and wholesale it for $1,500. He doesn't need to charge them. He doesn't need to audit it. He's just selling the printed circuit board complete with the Raspberry Pi chip and all of the circuits in there, all the EEPROMs all programmed up. Very quick, very clever. So he defined the licensing economics to know how to do this. We did the pricing, we knew the margins, and we used manufacturing logic to go and find the right party to do this. And once we've done that, of course, the project shifted from manufacturing, which he didn't want to do. This guy's in his mid-20s. He's married with kids, and he's working on the mine, adjusting air conditioning for haul pack trucks, those big trucks that the wheels are taller than people. And he found that he had to have two people to adjust air conditioning. Now he can do it with one. And so he wanted to just get back to do what he's doing. He wanted to make money on it, but he didn't necessarily want to do it. So we looked at targeting license conversions. It was a lot easier doing that, all because he did his assessment very early. Okay, so where do you want to go from here? What should you do next? Now, the worst step is simply to keep going without any sort of assessment for yourselves. If you've got an invention or a project, a research outcome, or a portfolio of ideas inside an organization, the next step is not necessarily to spend more money or to file more patents or to build more prototypes or pitch to more people. The next step is to reduce all of your uncertainty. Find out what you know and what you need to know, what you don't know, what matters commercially, and what risks are blocking the next transaction from happening. This is how you build your IP value and how you get to it, unlock it as quickly as possible. You don't build value by hoping the market will understand the idea. You build value by making the opportunity easier to understand, easier to assess, easier to support, and easier to say yes to if you do this right. So commercialization doesn't mean begin where everything else is certain. It begins where the important uncertainties are known, priorities are being managed. So if you do this right, this is what risk management does for intellectual property. It turns confusion into structure, it turns assumptions into evidence, and it turns ideas into commercial opportunities if you do this right. In the best cases, it turns intellectual property into income, and that's what we want to do for you. The reason we subsidise the IP Opportunity Audit at $995 is because it reduces risk for both parties. It reduces my risk as well, because if you're going to go forward, you might want to join my program, and I want to make sure that you're going to be successful. If you don't get a positive outcome on your IP Opportunity Audit, why should you go forward? Why should you spend your money? And why should I'm taking a risk by bringing you on board, and I don't want to do that. It allows me to determine whether a project has sufficient commercial logic, value potential, and pathway clarity before either side, that's you or I, commit to larger amounts of time, money, or resources. If you need to know, this is the quickest and most affordable option to get to know. So what do? Your next step is pretty easy. I've got 3 opportunities here, 3 next step links. If you get your cell phone out, you can take a photo or just open it up. Don't take a photo, just zero in on which one of these that you want to do. Now, these are still early, and if you're still early and you want a quick first assessment, start with the IP Commercial Opportunity or Commercial Readiness Test. That's free. If you have a specific project or organised portfolio that needs commercial assessment, book the IP Opportunity Audit. That's going to give you the clarity you need. And for $995, you've got an immediate snapshot. If you prefer to talk through your situation first or book a strategy call with me, there it is in the middle there. My strongest recommendation is that you don't let opportunity sit in uncertainty. If it has value, clarify it. If it has risks, identify them. If it has a pathway, structure it so you know what it is. And if it's not ready, find out before you start spending money in the wrong direction. That's the most important thing for you. Now, I'm going to pause here and open this up for questions for everybody. You can ask about your own invention, an R&D project inside your own organisation, a licensing or distribution pathway, a funding issue, or how you can decide whether or not an opportunity should be commercialised, or maybe even shelved, abandoned, or sold to another party. The more specific the questions, the more useful I can be for you. So let me stop sharing my screen here, and we'll come back and I'll just work you through this if you have questions for me. So I'm going to stop the recording now because it's fair